it's really important to actually understand what you are investing in and really fully recognize not only the returns, also the risks that you're taking on. Now, the capital structure, or sometimes known as the capital stack, particularly in real estate, it simply talks about how the companies arranged their financing, and it includes different sources of capital from senior to junior. Now, the senior debt here, for example, is really going to be focused on the senior debt, bonds, for instance, and junior is going to be most likely and most commonly the common equity involvement. Now, you need to understand this because then your place in the overall hierarchy and how this relates to the risks and returns of the various levels of investment along the capital stack. Now, if you invest in the common stock, you're essentially at the bottom of the heap. So if the company is liquidated, you're only going to receive payment after all of these other debts have been settled. Now, if the company does really well, as a common shareholder, you will do very well yourself and you'll gain as the company value gains. Now, if you instead focus on the debt and focus on bonds, which are usually much higher in the capital stack, this can have several advantages. Now, bonds are instruments that the companies are using to borrow money from investors. The bondholders essentially lend money to the company, and then in return, the company agrees to pay the bondholder interest, a payment on a regular basis for a fixed amount on that investment, and then repay the full value of that bond when it matures. Now, when you begin to think about this with a capital stack, why even bother with bonds? Well, one of the key reasons is it is a very predictable income stream. You know exactly what that investment is. It's not going to change. And so it can be really appealing to investors who are looking for a steady income stream rather than long-term capital gains. Now, bondholders have very low risk because they sit higher in that capital stack. They're going to have a more favorable risk profile. That is, they're going to have lower returns with that fixed income, but they also take on very little risk. And if there is a bankruptcy, the bondholders are going to be paid before shareholders. Now, if you're looking to diversify your portfolio, investing in bonds can also be quite helpful to settle out some of the swings that common equity often experiences in value. Now, for any person, any family, any group, the right investment is going to depend on your individual goals, your risk tolerances, and your investment horizon. It's always a good idea to consult with a financial advisor. For many of you, if you're used to common stock, thinking about bonds is different, and there's a whole load of other factors as well that you need to consider. But it does add safety, it adds security, and it adds a very steady and reliable income stream. So let me know in the comments down below, are bonds on your radar? Are they actually in your investment portfolio at the moment? And if not, why not? What would it take for you to add bonds to your portfolio?